technical analysis and how to read a chart on Tradingview. Hello! If you have ever opened a cryptocurrency chart and did not understand anything at all, these candles, lines, some indicators at the bottom, then this video is for you. Today, I will explain technical analysis to you from absolute zero, without water, without complex terms, in a human way. After this video, you will switch to Tradingview and will no longer feel lost. We will analyze what are candles and what do they show, how to read trends, support and resistance levels, the most important concept in TA, top 3 indicators that traders actually use, and how to put it all together to make decisions. Let's get started. Block 1. What is Tradingview? So, Tradingview is a free platform for analyzing any assets, cryptocurrency, stocks, gold, oil, everything is here. To get started, simply go to tradingview.com, sign up for free, and click on Charts in the top menu. Find an asset at the top, for example, type in BTC USDT. This is the Bitcoin to dollar rate on Binance. Here's our chart. It looks intimidating at first, but now you'll understand what each element means. On the left is price. On the bottom is time. This entire chart is just price over time. Block 2. Japanese candlesticks. The most important thing you need to understand is Japanese candlesticks. Each candlestick is a specific period of time. If you're on a one-day time frame, each candlestick equals 1 trading day. On a 1-hour time frame, each candlestick equals 1 hour. Each candle shows 4 prices. Opening, the price at the beginning of the period. Close, the price at the end of the period. High, the highest high at this time. And high, the lowest high at this time. The body of the candle is the distance between the opening and the closing. The shadows, or wicks, are the high and low. Now the simplest rule. Green candle, the price is increased. The closing price is higher than the opening price. Red candle, the price is decreased. The closing price is lower than the opening price. Look, I clicked on this candle and on top we see opening price 62,100, high price 63,500, low price 61,800, closing price 63,200. Green color means that it is increased. Now some important candlestick patterns that you should know. Pattern 1. Doji. Doji is when the body of the candle is very small. The opening and closing price are almost the same. This means uncertainty. Neither buyers nor sellers have won. Often signals a change in trend. Pattern 2. Hammer. Hammer is a candle with a small body on top and a long shadow on the bottom. The price fell but bounced back. Often appears from the bottom and signals an upward reversal. Pattern 3. Embedding. Bullish embedding, a large green candle completely covers the previous red one. Buyers have taken control. Potential signal to enter a long position. Block 3. Trends. Okay, we can read individual candles, but it is more important to understand the overall direction of price movement. This is the trend. There are 3 types of trends. 1. Uptrend. Price has higher highs and lower lows. Each subsequent peak is higher than the previous one. Each pullback is also higher than the previous one. This is a strong bull market. 2. Downtrend. The opposite is true. Lower highs and lower lows. Each bounce is weaker than the previous one. The market is controlled by sellers. 3. Sideways trend. The price moves horizontally within a certain range. It has neither an upward nor a downward trend. For most strategies, this is the most difficult market to trade. How to draw a trend line? We take the trend line tool from the panel on the left. In an uptrend, we connect 2 consecutive lows. The line shows where the market has found support. If the price breaks this line from below, the trend may end. Block 4. Support and resistance. This is the most important part of the video. If you understand what support and resistance are, you are already a head and shoulders above most beginners. Support is a price level from which the market has bounced up several times. This is where buyers are active. They see the price is cheap and buy. Resistance is a level from which the price has bounced back several times. Sellers are active here. They see the price is expensive and sell. How to draw? We look at where the price has stopped several times. We draw a horizontal line through these points. Look, the price has touched this level 3 times and bounced back. This is strong support. The most important rule is the reversal of roles. When the price breaks through the support level, it becomes resistance, and vice versa. The broken resistance becomes support. Here's a real example. Do you see this level of $60,000? At first, it was support. The price bounced back from it. Then the price broke through it down, and after that, when the price returned to $60,000, it already played the role of resistance. The price bounced back down. Why does this happen? Psychology. People who bought at support and got stuck in the red wait for it to drop to zero. When the price comes back to the entry point, they sell. This creates resistance. Where to look for strong levels? Round numbers, 40,000, 50,000, 100,000, the market loves them. Previous highs and lows, places where the price has stopped at least 2 to 3 times. Block 5. Indicators. Now, let's talk about indicators. There are hundreds of them in Tradingview, but most traders use a maximum of 2 to 3. I will show you the 3 most popular ones. To add an indicator, click Indicators at the top and enter a name. Indicator 1. Moving Average, or MA. A moving average is the average price over a certain period. For example, MA50 is the average price over the last 50 candles. Why is it needed? It smooths out the noise and shows the general direction. Rule: price above MA, an uptrend. Consider buying. Price below MA, a downtrend. Consider selling or step aside. Golden cross and death cross. When MA50 crosses MA200 from below upwards, this is a golden cross, a strong bullish signal. When from above downwards, this is a death cross, a bearish signal. Indicator 2. RSI, Relative Strength Index. RSI is the relative strength indicator. It measures how overbought or oversold the market is. It shows values from 0 to 100. RSI rules. RSI above 70, the market is overbought. The price was rising very quickly. A pullback is possible. RSI below 30, the market is oversold. The price was falling very quickly. A rebound is possible. RSI near 50, the neutral zone. Look, here the RSI dropped to 28. What happened next? The price bounced back up. Not always, but often. Important: RSI can stay in the overbought zone for a long time during a strong trend. Therefore, RSI is not used as the only signal for entry. RSI divergence is the strongest signal. Divergence is when the price reaches a new high and the RSI does not, or the price sets a new low and the RSI does not. This is a warning that the trend is weakening, one of the most reliable signals in technical analysis. Indicator 3, MACD. MACD, Moving Average Convergence Divergence, a complicated name but a simple idea. MACD shows the difference between 2 moving averages. It consists of MACD line, signal line, histogram. Main signal. MACD crosses the signal line from bottom to top, a signal to buy. MACD crosses the signal line from top to bottom, a signal to sell. Here, the MACD crosses the signal line up, and after that the price increased by 15%. Here's another signal. Not everyone works perfectly, but in combination with other tools, it gives good results. Block 6. Keeping it all together. Okay, now the most interesting thing is how to use it all together. Because one indicator or level is not enough. Traders look for the coincidence of several factors. This is called confluence. Here's a real example of analysis. Let's consider the following situation. Step 1. We determine the trend. We look at the overall picture. The price makes higher lows and highs. The trend is up. Step 2. We find the support level. We draw a horizontal line through the previous lows. Here is a strong level of $41,500. Step 3. We look at the indicators. RSI equals 33, close to the oversold zone. MA50, the price is exactly on it. MACD is starting to turn up. Step 4. We wait for confirmation. We wait for the candle to close. If it's a hammer or a green candle from the level, this is our signal. Step 5. Planning a deal. Entry from the support level. Stop loss slightly below the level so as not to accidentally break through. Take profit, the next resistance level. This is how a technical analyst thinks. Not, I think it will go up, and a clear plan. If A and B, then we enter. If not, we skip. Conclusion. Let's summarize what you learned today. Now you know how to read Japanese candlesticks and what they mean, how to identify a trend and draw a trend line, how to find support and resistance levels, how to use MA, RSI, and MACD, how to put it all together to make a decision. But I'll tell you honestly, knowledge of the theory and real trading are different things. Technical analysis does not give guarantees. It increases the probability of making the right decision, but does not completely eliminate the risk. Therefore, my advice, register on Tradingview, open the Bitcoin chart, and just practice. Draw levels, see where the price bounced off them, add indicators. Practice is the only way to learn to read charts. If the video was useful, like it. It helps the channel a lot. Subscribe so not to miss the next video where we will analyze specific trading strategies based on what we learned today. Write your questions in the comments. I will answer them all. See ya!